Gold just collapsed 20% while bombs fall. That sentence should be impossible. Yet here we are, and if you don't understand the machinery underneath this crash, you're about to make a catastrophic mistake. Let me be direct about something I've witnessed across 4 decades of managing capital through every monetary crisis in modern history. The investors who panic right now will regret it for years. The investors who understand what I'm about to explain will look back on this moment as the greatest buying opportunity of the decade. Which group you belong to depends entirely on the next 10 minutes. Subscribe now because what I'm seeing in March 2026 is not a gold failure. It's a gold reset. And the difference between those two interpretations will determine whether you build wealth or watch it happen from the sidelines. Here's what actually occurred, and I need you to focus because the mechanism is counterintuitive. Gold peaked at $5,589 on January 28th. By March 19th, it traded at $4,551. That's an 18.5% collapse in 6 weeks. During those same 6 weeks, Iran closed the Strait of Hormuz, oil spiked above $100, and the Middle East entered its worst military crisis since 1973. Every investor on Earth was taught the same rule. War equals fear, fear equals gold. The rule failed, or did it? Let me show you what everyone missed. The Federal Reserve held rates steady on March 18th and revised their inflation forecast to 2.7%. Jerome Powell stood at that podium and said explicitly that energy prices from the Iran conflict justified maintaining restrictive policy. Translation: oil shocks mean inflation fears mean no rate cuts mean bond yields stay elevated. And here's the trap most investors never see coming. When 10-year Treasury yields hit 4.25%, suddenly you're facing a choice. Hold gold that pays zero, or hold government bonds paying 4.25% annually with zero default risk. At 1% yields, gold wins that battle easily. At 4.25%, the math becomes brutal. You're paying a 4.25% annual opportunity cost to own an asset that just dropped 18%. That's the mechanism, not the war. The war made it worse because oil above $100 triggered exactly the inflation psychology that keeps the Fed hawkish, keeps yields elevated, and keeps the mechanical pressure on gold relentless. But there's a second layer operating simultaneously, and this is where the violence of this specific crash becomes clear. I call it the leverage cascade. Throughout 2025, retail investors poured $70 billion into gold ETFs. A massive portion went into leveraged products, the 2x and 3x funds that promise amplified returns. These instruments have a feature that most people discover too late. They rebalance daily. When gold falls, the fund must sell to maintain its leverage ratio. Selling creates lower prices. Lower prices trigger more mandatory selling. The cycle feeds on itself until every leveraged position is flushed. Gold spiked to $5,223 on the Hormuz news, then reversed violently, down 6% intraday as paper positions unwound. The product that helped retail ride gold to all-time highs became the guillotine that executed their positions at the bottom. They weren't selling because they changed their thesis. They were selling because the product's design forced liquidation. Meanwhile, something else was happening quietly across the Middle East. In 1983, gold suffered one of its worst crashes in decades. The reason? Gulf states selling reserves to raise dollars because OPEC's oil revenues had collapsed from oversupply. Saudi Arabia, Qatar, Kuwait, they all needed cash to defend currency pegs and fund governments. Fast forward to 2026. The mechanism is identical but inverted. Oil is $100, but the Strait of Hormuz is closed. They can't ship it. Storage is full. Production is being cut because there's nowhere to put the crude they're pumping. Revenue collapses not from low prices but from blocked pathways. And just like 1983, they're selling gold to raise the dollars they desperately need. Saudi Arabia holds 323 tons. Qatar 115 tons. Kuwait 79 tons. They don't need to dump everything. They just need to sell enough to cover the immediate cash flow crisis. That sovereign selling hits a market already under pressure from algorithmic liquidation. Hedge fund algorithms don't read geopolitical analysis. They read two numbers, dollar index and treasury yields. Dollar above 99, sell gold. Yield above 4%, sell gold. Both conditions triggered simultaneously on March 18th. Billions in paper gold contracts were sold automatically across hundreds of trading systems. Not because humans concluded the gold thesis was broken, because preset conditions were met. But here's what I find most revealing, and it's the signal I've learned to watch in every major correction over 40 years. The paper market crashed while the physical market held firm. Physical premiums stayed elevated. Asian central banks kept buying. Chinese institutions kept accumulating. COMEX vaults continued draining at the same rate we saw before the January peak. The futures price said panic. The physical market said accumulation. When I see that divergence, paper selling hard while physical demand remains robust, history tells me something specific is happening. Ownership is transferring from weak, leveraged retail hands to patient, unleveraged institutional buyers. The price crashes. The metal doesn't disappear. It just changes hands. And the hands catching it at these levels are the hands that understand the difference between the short-term mechanical price and the long-term structural price. The short-term price is set by three variables: real yields, dollar strength, and leveraged positioning. All three moved against gold simultaneously. The Fed's hawkish stance elevated yields. The dollar strengthened on safe haven flows. Leveraged ETF positions built up during the $70 billion inflow were force-liquidated by rebalancing mechanics. That's real. That's painful. And critically, it's temporary. The long-term price operates on entirely different variables: the debt cycle, monetary system credibility, central bank accumulation patterns, the fiscal arithmetic of a government carrying $36.2 trillion in debt while paying $1.03 trillion annually in interest, the first time in American history that debt service exceeded defense spending. None of those structural conditions changed on March 18th. The Fed revised a dot plot. The short-term price adjusted violently. The structure remained intact. Central banks bought 863 tons in 2025. They're on pace for similar accumulation in 2026. JP Morgan hasn't moved its $6,300 year-end target. Deutsche Bank still stands at $6,000. These aren't retail projections. These are institutional research departments analyzing the same FOMC decision, the same oil shock, the same data everyone saw. And they didn't blink. Let me tell you what I'm watching, because this is what actually matters. Two numbers. First, the dollar index. It climbed toward 99.9. When DXY breaks above 100, gold faces mechanical headwinds. When it falls below 97, which happens when markets start pricing rate cuts again, that headwind reverses. Second, the 10-year yield. At 4.25%, the opportunity cost of gold is maximized. When that yield drops below 3.5%, which occurs when recession fears override inflation fears, or when debt arithmetic forces the Fed's hand, the mechanical selling reverses. And here's the critical insight about those two numbers in this specific configuration. The United States is rolling over $9.2 trillion in debt this fiscal year. At 4.25%, that costs $391 billion more annually than at 2% rates. The arithmetic of maintaining 4.25% yields against a $36.2 trillion debt load is not sustainable indefinitely. Eventually, the mathematics force a policy response: rate cuts, yield curve control, quantitative easing under some new name. When that pivot comes, and the debt arithmetic says it must, the mechanical pressure suppressing gold doesn't just ease, it reverses violently. And it reverses into a market where central banks are buying nearly double their historical average annually, where physical demand from Asia never wavered, where institutional targets project 30% upside from current levels. In 1983, gold crashed as sovereigns sold. Then it consolidated for years. The investors who panic sold at the bottom and waited for confirmation before re-entering missed the entire next bull cycle. The investors who understood that the 1983 crash was a temporary cash flow event, not a structural shift in gold's monetary role, accumulated patiently through the noise. I'm not telling you what to do with your capital. I don't know your circumstances or risk tolerance. What I'm telling you is what I know from watching this exact pattern unfold before. The crash occurred in the paper market. Physical held, institutional targets held, central bank demand held. The debt cycle that drove gold from $2,600 to $5,589 didn't reverse because Powell revised an inflation forecast. The short-term mechanism shifted. The structure did not. Gold remains the only major asset with no counterparty risk, no issuer, no promise that can be broken. That property doesn't change at $4,551 versus $5,589. The price changed, the property didn't. And here's something most analysts are missing entirely. Silver dropped even harder than gold, down over 40% from its January peak. Why does that matter? Because silver always amplifies gold's moves in both directions. In every major gold bull market I've studied, silver lags on the way up, then explodes with 3 to 5 times gold's percentage gain when the reversal comes. The gold-silver ratio is now signaling exactly that setup. The crash in silver isn't evidence the bull market is over. It's creating the exact compression that precedes silver's characteristic outperformance. Watch the DXY. Watch the 10-year yield. When DXY breaks below 97 and yields drop under 3.5%, the mechanism reverses against a backdrop of persistent central bank buying, unsustainable debt dynamics, and institutional price targets that see 30% upside. The paper market crashed. The structural case remains intact. In 40 years, I've never seen those two conditions remain separated indefinitely. Most investors don't understand the difference between mechanical price and structural price. Now you do.